I want to tell you something that took me 50 years to fully understand. Not 50 years to learn, 50 years to fully understand. There's a difference. You can learn a thing in an afternoon. You can read it in a book, nod your head, say yes, that makes sense, and move on. But real understanding that is something that has to be burned into you. It has to cost you something. It has to keep you up at night a few times before it settles into your bones and becomes the way you actually operate. And the thing I want to talk to you about today cost a lot of people I know a tremendous amount. It costs some of them everything. I have been managing capital for over 70 years now. I have sat across the table from some of the most brilliant financial minds this country has ever produced, men and women with PhDs from places that would make your jaw drop, people who could run regression analyses in their head, people who understood options pricing and volatility surfaces and multi-factor models in ways that most professors never will. And I watched most of them at one point or another do the single dumbest thing you can do with a portfolio. Not the second dumbest, not something complicated and subtle. The single most catastrophic mistake in the entire game of wealth building. They ignored the one rule. Not a complicated rule, not a rule that requires an advanced degree to understand. A rule so simple that most people hear it and think they already follow it. A rule that looks obvious on paper and is psychologically agonizing in practice. And here's what I know from watching 50 years of bull markets and crashes and recoveries and bubbles and panics. The people who followed this rule consistently through thick and thin, through the excitement and the terror and the moments of absolute certain conviction that this time it was, different those people compounded their way to extraordinary wealth. The people who ignored it, even once, even for a moment, even with the best possible intentions and the most logical sounding reasoning, many of them never fully recovered. Pay close attention, because what I am about to tell you is a difference between the people sitting in the first-class cabin and the people who bought a first-class ticket and then lost it at the gate. Let us begin. Our rupture. There is one framework today, one, not 5 rules, not 7 steps, one framework with one central principle, and everything else is just context that helps you understand why you will be tempted to violate it and how to make sure you do not. I call it the indestructible portfolio, and the single rule at the center of it is this. You must never allow a single position to have the power to destroy you. That is it. That is the whole thing. I told you it was simple. I told you understanding it would take longer. The difficulty is not in grasping the concept. A 12-year-old can grasp it. The difficulty is in recognizing in real time when you are about to violate it, because you will always have a very convincing reason. You will always believe you are the exception. The logic will be airtight. The opportunity will feel asymmetric and obvious and urgent. And every single one of those feelings is precisely the thing that has destroyed portfolio after portfolio, going back through all of financial history. This is not advice for beginners. I want to be clear about that. If you have just started, if you are still building your foundation, the basics still apply. Spend less than you earn. Avoid consumer debt. Build your emergency fund. Invest early and often. Those are not what we are talking about today. Today I am talking to the person who is already in the game, the person who has some capital at work, the person who understands markets well enough to have an opinion, which is exactly when the danger begins. Because here is the dark truth: the more you know, the more dangerous you become to yourself. Let me explain why. The load gun. I want you to think about Russian roulette for a moment. I know that sounds dramatic. Stay with me. If someone offered you $1 million to play Russian roulette, one bullet in a 6-chamber revolver, most rational people would decline. The math is straightforward. You have a 1 in 6 chance of dying. No amount of money is worth that, because death is a permanent outcome. You cannot recover from it. You cannot dollar-cost average your way back from it. It is irreversible, and therefore even a small probability of it happening should be treated as an absolute veto. Now, let me ask you something. If someone offered you $10 million to play that game, would the answer change? Most people say no. And they are right, because the nature of the risk is not about the reward offered. It is about the permanence of the downside. When an outcome is irreversible, no upside justifies the exposure. Now here's what I want you to understand. There is a version of Russian roulette happening in investment portfolios all over this country right now. Right now, today, as we are having this conversation, people concentrating 50, 60, 70% of their net worth in a single stock, people borrowing on margin to double down on a position they are already certain about, people ignoring the basic rule of position sizing because they have done the research. They know this company, they understand the industry, and they are absolutely, completely mathematically certain that this is a winner. The bullet is always the one you do not see coming. That is the nature of risk. If you could see it coming, it would not be risk. It would be information. And markets price in information. What they cannot price in is the unknown unknown, the thing nobody is modeling, the asteroid nobody has spotted. When I was building my early partnerships, a mentor of mine, a man who had survived the Great Depression and still had every scar to prove it, he told me something I have never forgotten. He said the goal of the first 20 years is not to get rich. The goal of the first 20 years is to not get poor. I thought that was overly conservative when I was young. I was impatient. I wanted to build. I wanted to compound. I wanted to count. I wanted to act. And he let me think that for a while. Then he pointed at 3 men he knew. Brilliant men who had built real wealth, who had each, at one moment of peak confidence, concentrated everything into a single enormous bet and lost it all. Not most of it. All of it. And each of them spent the next decade not building new wealth, but reconstructing the foundation they had blown up. He said this: the math of recovery is the cruelest math in finance. If you have $100,000 and you lose 50%, you now have $50,000. To get back to $100,000 from $50,000, you do not need to gain 50%. You need to gain 100%. You need to double. From a depleted, damaged, emotionally crushed position, you need to double. If you lose 70%, you need to gain 233% to recover. If you lose 90%, which sounds extreme, until you look at any number of stocks in any significant market downturn, you need to gain 900%. This is not an opinion. This is arithmetic. And this is why the loaded gun, the concentrated position taken at the moment of maximum conviction, is the single most portfolio-destroying mistake in the history of investment. Here is your first assignment. Tonight, open your portfolio. Write down every position you hold and what percentage of your total investable assets it represents. Not your emotional attachment to it, not how much research you have done on it, the cold percentage. Then ask yourself honestly, if this position went to zero tomorrow, would you survive financially? If the answer to any position is no, you already have a loaded gun in your hand, and you may not know which chamber the bullet is in. The conviction trap. Now I want to tell you about the most dangerous moment in an investor's life. It is not the moment of maximum fear. In my experience, fear is actually a pretty good protector. When people are frightened, they tend to be cautious. They do their homework. They ask hard questions. Fear has a clarifying effect. The most dangerous moment is the moment of maximum conviction, because conviction, genuine, earned, research-backed conviction, is the thing that makes you abandon the one rule. I will tell you something about myself. I have had more conviction about certain investments than I have had about almost anything in my life. There have been companies where I felt I understood the business so thoroughly, where the numbers were so clear, where the moat was so visible and so deep and so durable that everything in me wanted to put every dollar I had and every dollar I could borrow into that single position. And I did not. Not because I was uncertain, because I understood the conviction trap. Here is how the trap works. The more research you do on something, the more familiar it becomes. The more familiar it becomes, the more your brain registers it as safe. This is called the familiarity bias. And it is not some minor cognitive quirk. It is a deep, ancient, hardwired feature of the human nervous system that was designed to help your ancestors survive in the savannah and will absolutely destroy you in a portfolio. Your brain genuinely cannot tell the difference between something it knows well and something that is actually safe. You know this company. You know the management team. You have read every earnings call for 6 years. You have visited the facilities. You have talked to competitors and suppliers and former employees. You know it the way. You know your own kitchen, the way you know the route to your childhood home. And your brain, because it has processed all of that information, sends you a powerful, confident signal: this is safe. but the company can still have an accounting scandal you could not have seen. The industry can get disrupted by something nobody modeled. The CEO can get sick. A regulatory change can destroy the business model overnight. A pandemic can freeze operations. The research you did eliminated the knowable risks. It did not and cannot eliminate the unknowable risks. And in my experience, the unknowable risks are the ones that actually hurt people. I watched this happen with devastating clarity during the 2001 collapse. I am talking about genuinely brilliant people, not speculators, not gamblers, people with serious intellectual firepower and decades of experience who concentrated enormous positions in technology companies they understood deeply and believed in completely. And they were right about the companies. Many of those companies were real businesses with real products and real futures. The analysts were not wrong about the quality of the assets. They were just wrong about one thing, that their conviction about quality eliminated the need for position management, and that one mistake wiped out fortunes that had taken decades to build. Let me tell you about two men I knew. I will not use their real names. I will call them Jack and Mike. Jack and Mike started investing around the same time, had similar educational backgrounds, similar starting capital, similar levels of intelligence. But they had one fundamental difference in how they approached position sizing. Jack operated with an internal rule: no single position, regardless of how much he loved it, regardless of how strong his conviction was, would ever exceed 10% of his portfolio. When his conviction was highest, when everything in him wanted to go all in, he treated that feeling as a warning signal rather than an invitation. He asked himself, if I am this certain, why? And what am I not seeing? Mike operated on a different rule: that extraordinary opportunities deserved extraordinary concentration. That if you really understood something better than the market, you had an obligation to yourself to maximize the position. That spreading across many positions just diluted the returns you had earned through superior research. 20 years in, the difference was staggering. Mike had two extraordinary wins that made him briefly famous in his circle. He had several catastrophic losses that took years to recover from. His portfolio was a roller coaster of brilliance and devastation. Today, he manages a fraction of what he should have built. Jack had no legendary wins, no stories to tell at dinner parties, no moments of I turned 10,000 into a million. His portfolio looked boring for 20 consecutive years, and then one morning he woke up and the compounding had worked its quiet, patient, relentless mathematics, and he had built something most people never build: permanent, durable, indestructible wealth. The lesson is not that Jack was smarter than Mike. Jack was, if anything, slightly less analytically gifted. The lesson is that Jack had mastered a principle that Mike had not, that in the game of wealth building, survival is not the consolation prize. Survival is the prerequisite for everything. You cannot compound what you no longer have. Here's your assignment for this section. I want you to think about the last time you had a high conviction investment idea. Maybe you have one right now. And I want you to do the following exercise. Write down every reason you believe in it, every piece of research, every data point, fill a whole page if you need to. And then on the other side of the page, write down this question at the top. What would have to be true for me to be completely wrong about this? And try to fill that page too. Most people can fill the first page in 5 minutes. The second page is where the work is. The second page is where the protection lives. The compounding contrite. I want to talk about the mathematical heart of all of this, because everything I've said so far is true, and all of it is context for this. The single most powerful concept in finance, the thing Einstein allegedly called the eighth wonder of the world, the thing that has built every large fortune I have ever witnessed being built over a lifetime: compounding. But not compounding as a concept. Not compounding as something you nod at and say, yes, of course, I understand compounding. I want to talk about compounding as a living contract, a contract that has one catastrophic exit clause built into it that most people do not read carefully enough. Here's the contract. You invest capital. That capital generates returns. Those returns are reinvested. The reinvested returns generate their own returns, and the process accelerates over time in a way that is genuinely counterintuitive to the human brain, because our brains are built to think linearly and compounding is exponential. Let me give you a concrete picture of what I mean. If you invest $100,000 at 10% per year and leave it entirely alone for 40 years, you end up with approximately $4.5 million. From $100,000, without adding a single additional dollar, without doing anything clever, without timing the market or picking the right sector or finding the next great disruptor, simply by staying in the game and not interfering. Now, here's what happens if you interrupt the contract. If during those 40 years, you have two catastrophic losses, two events where you lose 70% of your value because you violated the one rule and concentrated a position that blew up, and then you recover from each one at the same 10% rate, your $4.5 million becomes roughly $450,000. Same rate of return, same 40-year horizon, 1/10 of the outcome. Because two catastrophic events that interrupted the compounding machine cost you not just what they cost you everything that capital would have grown into. This is why my partner Charlie Munger used to say the first rule is never interrupt compounding unnecessarily. And why I've said for decades that the first rule is never lose money and the second rule is never forget the first rule. Most people think that is a joke or a clever aphorism. It is not. It is a precise mathematical description of the most important thing in long-term wealth building, that your primary obligation to your future self is not to find the highest return, but to protect the compounding machine from catastrophic disruption. A 12% annual return with no catastrophic interruptions will outperform a 20% annual return with two catastrophic events by an enormous margin over 30 years. I have run this calculation more times than I can count. The math is always the same. Here is the crucial thing about the contract that most people miss compounding. It does not care how hard you work. It does not care how smart you are. It does not care how much you want it or how much you believe in it. It is a purely mechanical process. Feed it capital, give it time, do not interrupt it with catastrophic losses, and it will build wealth that will genuinely shock you. But it has that one exit clause, and the exit clause is activated by concentration, by leverage, by ignoring the one rule in a moment of peak conviction. I can tell you exactly when 99% of my own net worth was accumulated. Not because I became dramatically smarter in my later years, not because I had access to better information, but because the compounding machine had been running long enough, without catastrophic interruption, that the numbers had reached a scale where the annual returns were themselves enormous. Most of my early decades looked modest. They looked like nothing was happening. And everything was happening. The foundation was being laid, the compounding machine was being built, and then one morning you look at the numbers and you understand what your younger self could not fully internalize. That the most important years of the journey were the boring, unsexy early years when the numbers were small and the temptation was greatest to take the big swing and shortcut the process. I did not shortcut the process. And that is the only reason I am here talking to you. Here's your assignment. I want you to get a piece of paper and calculate what your current investment portfolio would be worth in 30 years if it grew at 8% per year with zero catastrophic interruptions. Just use the rule of 72, divide 72 by 8, and you get 9. That means it doubles every 9 years. In 30 years, it doubles roughly 3.5 times. So whatever you have today, multiply it by 11. That is your 30-year number if you protect the machine. Now ask yourself honestly, how many times in the last 10 years have you come close to making a decision that could have cost you 50% or more of that? That number is your real portfolio risk, not the beta on your positions. The number of times you almost violated the one rule, up, timer, and of safety for interest. Now let me talk about the practical architecture of an indestructible portfolio, because everything I've described so far has been about what not to do. Let me spend some time on what to actually build. My mentor Benjamin Graham gave me a concept early in my career that I have used every single day since. He called it the margin of safety. And like most genuinely powerful ideas, it sounds almost too simple when you first hear it. The margin of safety means you never pay what something is worth. You pay significantly less. You build in a buffer, a gap between what you believe the intrinsic value to be and what you actually pay that protects you when you are wrong. Not if you are wrong. When? Because you will be wrong. I have been wrong more times than I care to count. My analysis has been flawed. My assumptions about the future have not materialized. My assessment of management has turned out to be optimistic. The world has changed in ways I did not anticipate. I have been wrong. The question is not how to not be wrong. The question is how to structure your decisions so that when you are wrong, and you will be wrong, the wrongness cost you an acceptable amount rather than a catastrophic amount. I think of the margin of safety as a fortress. And a fortress is not built to look good. A fortress is not built to impress visitors. A fortress is built to protect against the worst-case scenario. It is deliberately over-engineered for situations that may never come. And most of the time you live in the fortress and nothing terrible happens and you wonder why you bothered building the wall so thick. And then one day, the thing comes that you could not have anticipated, and you are protected. And the people who built elegant houses with no walls are not. I have a simple version of this that I apply to portfolio construction. I call it the two-layer fortress. And it works like this. The outer wall is diversification. Not the kind of diversification that means you own 40 stocks and feel safe, but genuine diversification across businesses, industries, and in some cases geographies, such that a single catastrophic event in one area cannot penetrate all your positions simultaneously. The inner wall is valuation discipline. You do not pay a price that requires everything to go right. You pay a price where even if some things go wrong, even if your assumptions are 20% off, you still do not lose permanent capital. The most common way people destroy their fortresses is they do one of two things. First, they let a position grow through appreciation until it represents a dangerous percentage of the portfolio, and they do not rebalance because they do not want to pay taxes on the gains or because they are emotionally attached to the story. Second, they add to a position at a price where there is no longer any margin of safety because their conviction has grown alongside the price, and they confuse those two things. Conviction and valuation are not the same thing. I have had maximum conviction about businesses at prices where the margin of safety was thin to non-existent, and I have done nothing. I have had moderate conviction about businesses at prices where the margin of safety was enormous, and I have acted aggressively. The decision to invest is not a function of how certain you feel. It is a function of the relationship between price and value. Here's a story I want you to hold on to. In the late 1990s, during the peak of the technology bubble, I was asked constantly why I was not participating. Why was I sitting in Omaha not owning the companies that were doubling and tripling every year, while other managers looked like geniuses? And my answer was always the same. I said I cannot find a price at which these companies offer a margin of safety. The expected return at current prices does not compensate for the risk. I said this for 3 years while looking temporarily foolish. And then 2001 arrived. The fortress held. Not because I was smarter, because the two walls were intact. Here is your assignment. Take your top 5 holdings right now. For each one, ask yourself 2 questions. First, at the price I paid, what bad things would have to happen for me to still be okay? If you cannot answer that question, you paid without a margin of safety. Second, what percentage of my total portfolio does this represent today, not when I bought it? Growth can turn a responsible 5% position into a dangerous 25% position over time without you making a single additional purchase. That is not discipline. That is neglect. Check the walls regularly. A fortress that is not maintained is just an old building. Up temp. The behavioral enemy. I have spent most of this conversation talking about the mechanics of portfolio construction, the math, the position sizing, the margin of safety, the compounding contract. All of that is true, and all of it is important. But here's the truth that most financial educators will not tell you, because it is uncomfortable and because it implicates them as much as it implicates you. The math is not the hard part. The math is almost insultingly simple. Diversify. Do not concentrate. Demand a margin of safety. Do not interrupt compounding. These are not complex ideas. A moderately intelligent teenager can understand them in a single afternoon. The hard part is the behavioral part. The hard part is your own brain. And I want to talk about your brain for a few minutes because I believe this is the most important section of everything I am telling you today. The human brain was not designed for investing. It was designed for survival on the African savannas somewhere between 50,000 and 200,000 years ago. And the decision-making hardware that kept your ancestors alive in that environment is almost perfectly miscalibrated for making good long-term financial decisions. Here's what I mean. Your brain is wired to feel pain from losses more intensely than it feels pleasure from equivalent gains. The research on this is consistent and clear. Losses feel approximately twice as painful as gains feel good. A $10,000 loss is emotionally equivalent to a $20,000 gain. This is not a personality quirk or a sign of weakness. This is fundamental to how human emotional processing works. And the investing implication is devastating. It means that when a position is down, you will feel compelled to sell not because the logic has changed, not because the fundamental thesis is broken, but because the pain of watching it decline is neurologically unbearable. And when a position is up, you will feel compelled to hold it long past the point of rational valuation, because selling means admitting the ride is over. You buy high and sell low not because you are irrational. You do it because you are human and your emotional hardware is running a survival program from 100,000 years ago. And then there is the other side, the greed mechanism, when markets are rising, when your friends are making money. When every headline tells you that the smart money is all in on something, your brain releases dopamine. The same neurochemical that makes food taste good and relationships feel rewarding. And in the presence of that dopamine, your risk assessment system is suppressed, literally suppressed. The parts of your brain that evaluate downside scenarios go quiet when you are in a dopamine state. This is why every bubble in financial history has involved intelligent, experienced people making decisions that look completely irrational from the outside. They were not irrational. They were chemically altered. The market had given them enough winning experiences to suppress their loss avoidance circuitry. And in that state, they concentrated positions, abandoned margins of safety, and violated the one rule. And I want to tell you something very personal here. I have felt that pull. I am not immune to it. Nobody is. There have been moments in my career where everything in me, every neuron, every instinct, every excited cell in my body wanted to go all in on something I loved, something I believed in, something I was more certain about than almost anything I had ever analyzed. And in those moments, the only thing that protected me was not superior intelligence. It was a rule I had written down when I was calm, in a moment without any specific temptation that I had committed to following regardless of how I felt. The rule does not bend for conviction. The rule does not bend for certainty. The rule does not bend for genius. The rule bends for nothing. Because here is what I know: the moments when you most want to violate the rule are precisely the moments when it is most protecting you. The strength of your desire to concentrate is a signal that your emotional hardware is activated. And when your emotional hardware is activated, your risk assessment hardware is suppressed. It is not a coincidence that you feel most certain right at the moment you are least able to accurately evaluate risk. This is the behavioral enemy. It lives inside you. It has lived there for your entire investing life, and it will be there every time you open your portfolio. You cannot eliminate it. You can only structure your decisions so that it cannot reach the controls. Here's your assignment. I want you to write down, today, your position sizing rules, not as a vague intention, but as a specific numbered document. No single position will exceed X%. I will rebalance when any position exceeds Y%. I will not add to a position unless the margin of safety criteria are met. These are your rules. Write them when you are calm. Commit to them publicly. Tell your spouse, your partner, your closest financial confidant. The research on behavioral commitment is clear. People who make public commitments follow through at dramatically higher rates than people who make private ones. Put the rules between you and the behavioral enemy, because one day, and I promise you this day is coming, you will be sitting in front of an opportunity that feels so clear, so obvious, so mathematically certain that everything in you will want to ignore what I have told you today. And the only thing standing between you and a decision you may never recover from will be those rules. Now, I want to stop giving you tactics for a moment. I want to talk about something that I think matters more than any of it. I am 93 years old. I've been doing this since I was 11. I have watched the markets from the Depression through a dozen recessions, through wars and panics and bubbles and crashes and recoveries. I have known men who turned their last $1,000 into empires and men who turned their empires into dust. And what I want to tell you, what I genuinely, urgently want to make sure you understand, is that the purpose of all of this is not the money. The money is real. The compounding is real. The math is correct and the rules work, and if you follow everything I have told you today, you will build more financial security than you would have without it. But I have sat at enough hospital beds I've been to enough funerals of men who died with 9 figures in their accounts and almost nobody in the room who genuinely loved them. I've watched people spend 50 years protecting their portfolio from catastrophic loss while allowing catastrophic losses everywhere else in their lives. The same intensity you bring to not concentrating your financial portfolio, do you bring it to your relationships, to your children, to the friendships that actually matter, to your own health and peace of mind? Because here is something I have learned, and I want to say this very directly: the rocking chair test is real. Someday you will be old. Maybe not as old as I am, but old enough to look back clearly. And I promise you that the thing you will regret is not the investment you were too conservative about. It is not the position you did not concentrate enough. It is not the year you left some return on the table. You are going to think about the people you were not present for, the phone calls you did not make, the forgiveness you withheld, the pride you protected when you should have been building connection instead. The wealthiest man I ever knew personally, wealthier than I am, significantly died in a hospital room in Florida with a lawyer present and nobody else. His family relationships had been casualties of exactly the same thing that built his portfolio: absolute single-minded concentration. He had concentrated everything: his time, his attention, his emotional energy, his presence, all of it into building the empire. The empire was enormous and beautiful and completely impervious to love. On his last morning, his lawyer told me, he asked about his oldest son. He had not spoken to the son in 17 years. A business dispute, originally. Then just silence. And at the end, when the chips were all cashed and the game was over, that silence was the only thing in the room. I am not telling you to be poor. I am not telling you to be poor. I am not telling you that money does not matter. Money matters. Financial security matters. The ability to protect your family, to have choices, to not be trapped in a job you hate or a circumstance you cannot escape, that matters deeply. And the rules I gave you today will help you build it. I am telling you that the one rule: never let a single position have the power to destroy you, applies everywhere. Not just in your portfolio, in your life. The person who builds an identity entirely around professional success has a concentration problem. The person who puts all their emotional eggs in one relationship, one friendship, one source of external validation has a concentration problem. The person who spends decades optimizing for one metric: net worth, status, achievement, while neglecting the diversified portfolio of health and love and presence and integrity, that person is running a loaded gun without knowing it. And I have watched that gun go off. The measure of a life is not the number at the end of the spreadsheet. The measure of a life is whether the people in that hospital room at the end are there because they want to be. And the only investment that pays that kind of return is the investment in being the kind of person who deserves that presence. Chip? So let me close this. Today we talked about the indestructible portfolio and the one rule at its center: you must never allow a single position to have the power to destroy you. We talked about the loaded gun, the lethal mathematics of catastrophic loss, and the asymmetry of recovery that makes concentration not just a bad idea, but potentially an unrecoverable one. We talked about the conviction trap, the cruel irony that your most dangerous investment moments are your most certain ones, because certainty suppresses risk assessment, and because the risks that actually hurt you are always the ones you did not know to look for. We talked about the compounding contract, the almost magical mathematics of uninterrupted growth over time, and the brutal cost of allowing catastrophic events to break the machine. We talked about the margin of safety fortress, the structural discipline of paying less than value, of over-engineering your defense for worst-case scenarios that may never arrive but will arrive eventually. And we talked about the behavioral enemy, the ancient hardware in your own brain that will fight you on every one of these rules at the exact moment when the stakes are highest. And then we talked about what actually matters. Now, here is what I need you to do. Not tomorrow, not when you have more time. Now, open the portfolio, check the concentrations, write the rules, tell someone about them, build the fortress, and then close the laptop. Put down the phone. Go be present for someone who will be in that hospital room because they want to be. Because the indestructible portfolio is not just the spreadsheet, it is the whole thing: the capital and the character and the relationships and the integrity and the presence, built slowly, protected fiercely, compounded over a lifetime. That is the game. That is how you win it. Not with the biggest position or the boldest bet or the most brilliant analysis. With the one rule. followed every single time, especially when every party wants to break it. That's all. Thanks for watching.